Asset allocation, or the balance between growth and safety, is the most important investment decision that individuals make. Don't let that frighten you. All you have to do is get the balance reasonably correct. There is no perfect balance between growth and safety because determining the balance is as much art as it is science. The more growth in your portfolio, the greater the up and down swings, and the more safety in your portfolio, the lower the expected rate of return. An influencing factor in today's investment climate, and this has been true for the last 8 or 9 years, is that safety doesn't pay much. Look at GIC rates. Even 5-year rates are abysmally low. However, we can't shun safety. A 2% rate of return looks good when growth plummets. During the horrible 3-month period ending November 30th, 2008, global markets fell roughly 30%. If you were 100% invested in growth, your portfolio fell roughly 30% in 3 months. If you had half in growth and half in safety, your portfolio fell roughly 15%. That is the benefit of a balance. If you rebalanced after the fall and moved money from safety to growth, you did well on the rebound and have done well since. The old adage of buy low, sell high is a good one. If you did nothing, you have fared well as well, and your portfolio has grown well beyond the low of February 2009. Those who panicked and moved all to safety have earned roughly 1 or 2% since. A few definitions. Growth is what you buy that you anticipate will appreciate in value. A house, a vintage car, art, a stamp collection, and partial ownership of companies fit the definition. Partial ownership of companies, or shares of companies, are the common growth investment. Companies tend to pay dividends, whereas a stamp collection doesn't. Safety is when you lend your money out. When you buy a bond or a GIC, you are lending your money. You expect interest and your money back when the term matures. Generally speaking, growth returns more than safety, and the value of growth swings higher and lower than safety. Everyone should have some of both. How do you arrive at an appropriate balance between growth and safety? The longer the time period until you need the money, the greater the proportion of your portfolio you can comfortably invest in growth. If markets plummet, you can wait it out and participate in the bounce back. I'll talk about rebalancing in a minute. I'll use me as an example. I am 55 and I may retire at 60. How long is my time horizon? I need no money from my savings for at least the next 5 years, so all of my money has at least a 5-year time horizon. Then, when I retire, I will need a chunk of money to pay for the first 5 years of retirement, then a chunk for the next 5 years, and so on. If I live to 90, I have 6 5-year chunks between 60 and 90 years old. And I need 1 of the 6 chunks in the next 10 years. So, 5 out of the 6 chunks have at least a 10-year time horizon. Most of my money, therefore, has a long time horizon. The time horizon of my savings supports holding a large portion in growth. Most people have a longer time horizon than they think, with savings earmarked for retirement. If I am saving to buy a car in 3 years, I should be investing all this money in safe investments. The time horizon is short. The next determinant is risk tolerance. How do you react when growth gets decimated? Those who rebalance fare the best. Those who do nothing fare okay. And those who move to safety lock in low returns and miss the bounce back. How do you react in horrible growth market conditions? No one truly knows their tolerance for risk until growth markets get pummeled. It isn't easy to watch your hard-earned savings lose value day after day. I touched on this earlier, so I won't comment on this slide. Let's sum up. Time horizon is measurable, risk tolerance isn't, and growth earns more than safety in the long term, and especially when interest rates are low and potentially rising, as in the current 2017 environment. I've touched on this implicitly. As time passes, your time horizon grows shorter. Ignoring all other variables, this suggests that the proper balance between growth and safety should change in the direction of safety as years pass. Rebalancing should be considered at least once per year. Rebalancing is akin to buying low, selling high. Let's use an example to explain the necessity of rebalancing. Let's say you determine a proper balance is 50% each for growth and safety. After 1 year, growth doubles and safety does not change. Your portfolio is now 2/3 growth and 1/3 safety because of the doubling of growth. Rebalancing would move it back to 50% each. You would sell growth and buy safety. That is easy. Let's look at the harder case. Growth falls 50%, so your portfolio falls 25%. Yes, the proper thing to do is sell safety and buy growth to get back to 50% each. This takes some intestinal fortitude. The news headlines are all scary at this point. But remember, buy low, sell high. Rebalancing, by definition, is selling the asset class that is doing relatively better and buying the asset class doing relatively worse. It is counterintuitive, but it is buy low, sell high. Rebalancing may be necessary even if the balance between growth and safety does not change. Let's say Canadian equities do well and US equities underperform, but they offset so that the balance between growth and safety hasn't changed. Rebalancing money out of Canadian equity to US equity is necessary to get back to the predetermined mix. If you are making consistent contributions to your portfolio, rebalancing can be done by allocating the new money to the underperforming investments. So, summing up, the appropriate asset allocation changes over time. The actual asset allocation changes as investments grow at different speeds, and rebalancing matches the actual asset allocation with the appropriate asset allocation.